Hi, my name is Marieke Spence, and I'm the Executive Director of Impact Capital Managers. We are so excited to partner with iConnections and with our peers in the field, Series 100 Women in Finance, and the Children's Environmental Literacy Foundation on Impact and Inclusion Week 2020. Founded in 2019, ICM has a mission to accelerate the performance of our members and scale the private capital impact investing marketplace with integrity and authenticity. We do this through our invitation-only membership association, which today includes more than 50 venture, private equity, debt, and real assets funds representing more than $12 billion in impact-focused capital, and through field building initiatives and partnerships. ICM's members share a passion for supporting entrepreneurs and scaling businesses that will realize a more equitable, resilient, and sustainable future, and the knowledge that skillful impact investing can, in fact, achieve superior returns. Like you, ICM's members are dedicated to driving meaningful change on diversity, equity, and inclusion. Core to our mandate to scale the impact investing marketplace with authenticity is a commitment to cultivate a robust, diverse, skilled impact investing workforce for the future. Thanks to the generous support of our grant partners, we were able to put that commitment into action this past summer with our Mosaic Fellowship. The fellowship placed 8 brilliant MBA students from traditionally underrepresented backgrounds at ICM funds over the summer to learn the ropes of impact investing from best-in-class managers. Our ambition is to expand Mosaic to serve more amazing students next year. Please let us know if you'd like to be involved. Without further ado, I'd like to turn things over to today's panel. Our panelists today include Stonely Baptiste Blue from Urbaness, Bobby Turner from Turner Impact Capital, Daniel Pianko from Achieve Partners, and Renske from First Course Capital. Together, they represent deep expertise in workforce and education, food systems, climate resilience, and affordable housing. Over the course of the next 30 or so minutes, you'll hear their direct responses to 3 questions on the alpha and impact, what that phrase actually means in practice, and how they are seeing the particular challenges and opportunities of this amazing moment as we're experiencing triple disruptions of climate change, a global health crisis, and the growing movement to address racial justice and equity. Thank you so much.
Our firm was built partially on the recognition that there is an emergence of mission-driven founders that wanted and needed support from aligned investors. We suspected that an increasing number of these founders would find themselves wanting to fight climate change in particular, and in their backyards, which is commonly the urban landscape. As a result, our deal flow has consistently grown over the years. In our first year, we reviewed maybe 200 startups. 7 years in, we now see almost 2,000 startups a year. We also knew from our experience as startup founders and in previous early stage investing that building a startup is very hard and comes with a slew of daily challenges with uncertain outcomes. Impact-oriented companies drive their companies based on a mission, true north, which also helps them drive to meet those challenges. In our case, the mortality rate of our portfolio is actually less than 1% after more than 80 investments. We've also found great impact tailwinds in helping our companies recruit and retain talent. According to Psychology Today and numerous studies in the past 20 years, purpose is one of the top 3 employee motivations for top performing companies. The other way our impact lens has positively resulted in returns is that it's aligned with consumer trends in very large and growing markets. Today, more than half of consumers believe that companies have a greater responsibility to act on issues related to their purpose. In 2019, Fortune magazine found via a survey that an incredible 72% of respondents believe companies should be mission-driven, as well as focused on the bottom line. And 64% said that a company's primary purpose should include making the world better. For us, sometimes that alignment looks more like discovery, such as the emergence of vintage clothing demand that our company Shop Thrilling has successfully captured and is using to drive reduced clothing waste. And sometimes the alignment looks just like pure fun, which our company Future Motion has used to build a multi-$100 million business by making light electric vehicles fun and stylish.
I think anytime we talk about impact driving returns, I think we must have to acknowledge that over the past 25 years, and even today, most investors don't believe it's possible. They don't believe that profits and purpose can play nicely in the sandbox. And of course, if you're going to superimpose a social return or metric on a financial investment, it's going to come at a sacrifice in yield. I remember back in 1998 when Magic Johnson and I went out and partnered to raise a $300 million fund to build community-serving infrastructure in densely populated minority communities. And I remember that we agreed on most of the underlying characteristics of the opportunity, but quickly disagreed on how long it would take to raise the fund. I bet it would take 6 months. He bet me it would take 2 years because of the misperception of the opportunity. And the fact is we were both right. It took us 2 years and 6 months to raise the fund. But with strong results over the subsequent 15 years, we went on to raise $2 billion of private equity capital, facilitating nearly $6 billion of urban revitalization. We generated tens of thousands of jobs, provided essential service and amenities, and equally as important, we drove strong risk-adjusted returns for our investors. So today, we're in a unique position. For the last 20 years, we've continuously proven that operating with an impact lens, i.e. social impact investing, doesn't come with a sacrifice in yield. And in fact, if it's done correctly, it can actually drive better risk-adjusted returns than more traditional investment strategies. Purpose drives risk-adjusted returns because it's not based on speculation. We're not trying to create demand with social impact investing. Rather, we're focusing on opportunities where the underlying demand is large, it's growing, it's unmet. Think about education, workforce housing, healthcare, the need for fresh water, or even clean air. Purpose drives risk-adjusted returns because the underlying demand is less correlated to the broader economic conditions. This in turn drives defensive and diversifying alpha for a portfolio. Purpose drives risk-adjusted returns because it's where opportunities are misperceived and difficult to underwrite and requires unique skills. And I think finally, purpose drives risk-adjusted returns because there's a lack of competition in the space. Impact investing has traditionally been where the investor has been the government and or philanthropy, and there's now decades long of proof that they fail at driving sustainable, durable, and scalable change.
Absolutely love the Tideline report that came out that detailed how agents of impact can change and transform companies. What I love about impact investing is when I hear a story where everyone's incentives are aligned, where it makes sense for our LPs, how our LPs make money is directly tied to our social impact. There's no daylight between those two things. For what I do, I notice that on the way into an investment, we can talk to an owner in a very different way. We invest in traditional businesses in skill gap areas, and then we transform them through education to make them talent as a services businesses. And so when we go and talk to an owner of a skill gap business, they look to us and say, hey, you're bringing something different, unique, this training methodology to us that we don't have. And that really hits home because a lot of times people say, hey, it's just important for me in my industry to help develop it. Same reason someone would be a teacher somewhere. But where it gets really emotional is when you go and you talk to an owner and he says to you something to the effect of, if people don't have this very specific skill set in healthcare, so example, cath lab nurses, so people who fix your heart after a heart attack, then people die. Because if all the requisite skill sets aren't in the emergency room at the right time, then they can't leave a cath lab open. And I want to partner, I don't talk to private equity firms, but I'm going to talk to you because I want more people who can do this to save lives. And so we get a totally different seller as we come into a business. And then in terms of like actually optimizing a business, we're training people. So we're bringing in effectively apprentices. So when someone joins us, we actually pay them a little less, and that allows us to be a low-cost provider. But we actually are able to generate more revenue as well, because while we're training them, they're actually working for an end company. And it's basically try before you buy. If the end company likes that person at the end of their project, a year, 2 years later, then they can hire that person. So we're able to come with a unique value proposition that not only will we provide you a nurse or a cybersecurity professional or electronic medical records professional, but at the end of the project, you can hire that person. And then on the exit, we can drive more value because through this process of creating apprentices and better long-term alignment with your end customer, you actually become a different type of company. No longer are you a transactional, hey, we're going to fill your rec for you, we're going to fill your specific human capital need. We're going to become your human capital partner, and we're going to provide talent to you on an annual basis, more as a business, strategic business relationship. And that allows us to be called a talent as a service provider, which tends to trade at a higher multiple. So we'll buy companies for 6 to 10 times EBITDA and then sell them for like 20 plus times EBITDA.
Due to COVID-19, most people are taking precautions, rightfully so, to reduce the transmission of the disease. But one negative consequence of that, and one concerning trend for me, is the increased purchase of personal cars. This has network effects like congestion, which long-term will impact quality of life, but it also has systems effects like lower funding for public transit. And what kind of vehicles being purchased matters as well, as most folks still don't understand electric vehicles. So 98% of vehicles purchased today are still gas and diesel, which ultimately will result in increased carbon emissions and increased negative impact on climate change. So another concern on our radar is the budgetary challenges that local governments are facing and the resulting cuts in climate programs and emission reduction efforts, but also the risk that local services may suffer, and as a consequence, air quality, water safety, and general public safety. But what's encouraging for me is that there has never been more awareness of systems level issues and risk as there is today. We're also seeing a reimagining of city life, from the use of public streets to rethinking commercial real estate. In general, we're seeing more and more momentum pushing for action on climate change. And I get up in the morning excited to meet founders who are newly inspired to build solutions and offer new ways to meet these challenges. I'm also encouraged by climate positive regulations like those in development in California, mandating that all new passenger vehicles sold in the state by 2035 be electric vehicles. This state is following regulations from 15 other countries that have called for similar bans on the sale of new vehicles. I think if we use this moment from the fires to COVID-19 to recognize that we really do have to change how we operate at a systems level, we could come out better for everything that's happened this year.
What keeps me up at night? Unfortunately, just about everything these days. You see, even before COVID-19, our country has been falling short of its basic ideas. When we think about it, there's 43 million families or Americans living on food stamps. Only 1 in 3 public school students are proficient at grade level. 78% of full-time workers are living paycheck to paycheck. I think it's 1 in 4 families, nearly 12 million renter families are severely rent burdened, spending in many instances upwards of 60% of their income on rent. And that comes at the sacrifice of food security, health security, and retirement security. I think last year, nearly 20% of our GDP was spent on healthcare. Yet despite spending nearly $3.6 trillion, our healthcare outcomes are in the bottom quartile of industrialized nations. The fact is that today there's tens of millions of families whose economic, educational, and healthcare outcomes are predetermined by where they are born, families living in survival mode, living paycheck to paycheck, family for all intent and purposes that have been foreclosed out of the American dream, and it's just not sustainable. And add COVID to the equation, and you further exacerbate the disparity of opportunities. And while it's too soon to determine the magnitude of disruption caused by this pandemic, it's clear to me that on one hand, this pandemic will hit our minority communities much harder than others and highlight just how fragile our most vulnerable communities are to economic, political, and unforeseen emergencies. It's also going to exacerbate the government's inability to create lasting solutions to some of our most pressing challenges, because there are, quite candidly, just going to be fewer dollars to spend on the social safety net of healthcare, education, and housing. On the other hand, what gets me up in the morning is that this crisis will confirm our thesis that the underlying demand for impact investing is huge and growing, and moreover, its returns are less correlated to the broader market indices and economic conditions. Simply put, Impact investing has never been more critical to our future, and it's never been more rewarding as an investor, and that's what gets me up every morning.
What concerns me about impact investing? Frankly, the biggest problem, and there's actually a Wall Street Journal article, opinion piece earlier, it's that it's so hard to define what is impact. It's so hard to say, yes, this is a better mousetrap. We're taking carbon out of the air. But what if we're taking carbon out of the air in a way that actually creates more carbon? And so actually evaluating impacts is one of the hardest things. And so what keeps me up at night is people who are saying they're doing impact investing who aren't really doing impact investing. People who are saying, hey, we're doing something really great. But then when you start peeling behind the envelopes, all you need are one or two front page articles in the Wall Street Journal about how impact investing isn't really real to destroy the industry. And so I think it's really important for all impact players to create very specific metrics and strategies to ensure impact compliance. And I think too often it's focused on process versus outcome. And the real thing is, okay, are we actually having an outcome? When we put together our impact metrics, we want them to be very quantitative. Our fund is called Putting America Back to Work. And our goal is to create 100,000 good first jobs for Americans. And so we evaluate every single one of our companies on how many people they hire, who they hire. We want to make sure that we have people from underrepresented communities, whether people get through the programs relatively equally, and then how many people end up getting hired at the end of the day. And the way to think about that is if we can train, each of our companies can train and get employed 1,000 people a year. We have 10 companies in our portfolio, 10,000 people trained and placed every year over a 10-year live fund. That's 100,000 good jobs for Americans. So we're really excited about creating sort of a very defined impact statement and the ability to show people with numbers your very specific impact. And that's what keeps me up at night, is that not every firm is as focused on quantifying impact, qualifying it, and making sure they actually implement it.
So investing in the food system with the backdrop of wildfires in my home state of California and many more raging in other Western states, it is hard not to be seriously worried about the farming and agricultural communities that are so significantly affected right now. And of course, the downstream impacts on all of us as far as our food supply is concerned. There are obviously also a number of worries and concerns about this being a new normal here in the Western states that we will need to adapt to, while we also know there are many measures that can and should be implemented to build climate beneficial systems overall, not just within food and agriculture. Prior to the fires and persisting throughout the pandemic are the very real concerns and stresses about where and how we will continue to source our food. The rigidity and commodified nature of the dominant industrial food paradigm here in the United States has revealed many pre-existing problems in our food supply chain, including excessive waste, public health concerns, and environmental concerns about confined animal agriculture operations, metabolic disease attributed to diet, food safety concerns, and much more. What gets me out of bed each morning is the incredible resilience, ingenuity, creativity, and endless pursuit of solutions that the entrepreneurs that we invest in, who are focused on rebuilding resilient food systems, disintermediating and disrupting the very opaque parts of the system that have largely contributed to value not being captured by producers, growers, and farmers, and the entrepreneurs who are addressing so many more challenges in food and agriculture through building scalable, mission-driven businesses.
Regarding diversity and equity, I think it's still too early to tell if the tides have truly changed, especially in venture. But I do get a sense that the global conscious is slowly shifting. And I'm talking about a conscious shift that really does still feel like it's at its beginnings, but particularly in venture still faces two very strong headwinds. First, in venture capital is historically built on pattern matching and networks, which inherently perpetuates inequity and limits access. Second, the way we think about value, risk, and opportunity are still misaligned when it comes to broader demographics of talent and founders. What we're currently seeing in diversity and inclusion efforts and funding specifically for underrepresented talent and founders, they're a needed prelude to the real shift that we need. But I think that what's still missing is a shift in perception from you, quote unquote, should invest in Black and female founders, funds, talent, etc., because it's the quote unquote right thing to do, to, I think a better perspective is you are at a disadvantage if you don't. Frankly, the world by sheer demographic growth is becoming a truly competitive and inclusive landscape. And if you can get ahead of the curve in recognizing the best people and opportunities in spite of what they look like or come from, you will have more upside, less risk, and your experience investing and operating will be richer. And I speak from experience in looking at our portfolio where our fastest growing companies are led by female founders and underrepresented founders. So valuing diversity has truly been an asset for our fund.
As I said earlier, over the past 25 years, we've proven that impact investing, social impact investing, if done correctly, doesn't come at a sacrifice in yield. But let me be clear, it does come with a unique set of risks. When I partnered with Magic Johnson 20 years ago, he told me that two words would clearly define impact investing, and that was arrogance and distrust. Arrogance on behalf of capital providers, because we had capital, we were smart, we knew how to solve the problems of social justice or injustice. Distrust from those that suffer the consequences of social determination, who assume that capital is there just to make money. And to be successful, I learned that the only way to effectively bridge that gap between arrogance and distrust was by building an investment team that was first from the community and secondly, intimately involved or knowledgeable with the underlying issues. With this in mind, we built a team at Turner Impact that's 90% diverse, meaning non-white men. We're 50% women, and we're 100% fanatical about harnessing market forces to address some of our most daunting challenges. And our diversity doesn't stop at gender or race. It expands to issue expertise, where in addition to recovering bankers and consultants, we have former public school teachers, primary care physicians, law enforcement agents, and colleagues even that grew up in public housing, each possessing unique skills that are critical to identifying, quantifying, and mitigating the risks of financial and social risks of an investment. We're diverse because it's smart. If nothing else, our job as ICA members is to generate strong risk-adjusted returns for our investors by quantifying and mitigating risks. And because impact comes with a unique set of risks, diversity plays a critical role in fulfilling our fiduciary responsibility to our investors. I like to think that empathy is far better an underwriting tool than sympathy.
I do think we are at a watershed moment in terms of the recognition that we need to do better in our fields of investing around addressing inequity, both on the decision-making side, the investor funder side, as well as on the entrepreneur and founder side. We have all seen a number of pledges and commitments around addressing these complex problems, but in my opinion, sharing the words of a colleague, we need to move from well said to well done. And those of us with the power to recreate structures and systems need to be engaged at all levels from the bottom up. We need to be building pipeline partnerships within communities who have been historically marginalized, and we need to rethink our expectations and even the paradigms we're operating within in order to be truly accessible partners as investors. Valuing diversity is just good business from my perspective. The business case has long been made that diverse teams outperform their less diverse counterparts and make better decisions and so much more. It means, in my opinion, that we need to be thinking about problems that really need to be solved in the sectors we're investing in, as opposed to having solutions that are chasing problems and markets. I think it means really listening to the problem solvers in communities who might not even view themselves as entrepreneurs. They're just simply solving problems that need to be addressed. I think this all adds to a much more nuanced understanding of the spaces in which we are investing and puts us in the way of opportunities that others might not see who are looking with a particular pattern recognition in mind. Thank you.